Okay, very good morning. Tuesday the 27th of June. Just getting the briefing underway. And looking at the charts this morning, in terms of the opening price, not too much going on. It's kind of a bit of a reflection of the overnight news, really not too much of great significance to get you up to speed on. But a couple things just to have a look at, and I guess starting chronologically of what we had yesterday, where just looking at the DAX chart here on the center left, where we were off to a fairly strong start to the day. That followed through, and US indices followed suit all the way up until the US entrance, and we even blipped a little higher at the Wall Street Open before the dip that we saw post weaker US economic data. The durable goods orders was particularly soft, but the morning was supported on Monday by really two catalysts. For one, a bit of backstopping from the Italian government saw Italian bank stocks rally. The bailing out of those two kind of mid-sized banks, cleaning up some of their bad debt on their balance sheets, kind of helped alleviate some of the concerns and risk of those banks in Italy. So the FTSE MIB rallied, and consequently it did help lift some of the sentiment, and it also came, of course, in combination with the latest German IFO Business Climate Index, highest reading since this series began in 1991. So any indication of forward-looking how confident a company is over the next kind of 6-month horizon, even irrespective of the facts of things like Brexit, which is obviously ongoing and being negotiated at present. You can see here, we've got to go all the way back to kind of off the chart since we were this confident in terms of German firms on the situation at this present point in time. So that helped lift things. But as I said, then you had the durable goods orders, second consecutive negative print that we've had in that particular data set. And so we declined off those highs in the US equity markets. A little bit of a stabilization, but then towards the end of the Wall Street session we saw a bit of an extension of the sell-off. Worth noting though, the S&P finished basically flat, as did the Dow Jones. However, the Nasdaq was the bigger decliner. Obviously a lot of this downtick here was actually more pronounced in the Nasdaq index. This being because, of course, Donald Trump, not heard from him in a while, but back in the scene with Trump's travel ban, had been mostly cleared by the US Supreme Court, which in turn allows it could possibly take effect this week. It's talking about people from those 6 nations concerned who lack a bona fide relationship in the US. That again brought about this kind of concern about the immigration issue, tech sector being heavily driven in terms of the employment from immigrants, and as such their tech sector tends to get hit the hardest. If you remember, when the travel ban was first mentioned from Donald Trump several months ago, the most vocal out of all of the US corporations were the likes of Apple, of Google, Alphabet, Amazon, those types of big tech giants. And given the size of their workforces, and hence the reason, given their market capitalizations as individual firms is so large, the Nasdaq consequently underperformed. But the other indices also did follow suit. Also as well, sticking with Trump just briefly, the healthcare debate that is still ongoing. With the findings from the Congressional Budget Office on the proposed bill last night, the headlines are largely dominated by the finding that an additional 22 million Americans would be left without insurance in a decade under the proposals. That then meant that 3 Republican senators announced that they would block the bill from advancing. As a guideline, Majority Leader Mitch McConnell can only afford a maximum of 2 dissenters in order to get this pushed through before the recess, which is on the 4th of July, Independence Day in the US. So there's still a little bit of toing and froing on that particular issue. However, the travel ban as well coming back to the forefront might be something to monitor as well going forward. Any developments on that? We know that legally it had been blocked on 2 prior occasions. But taking us through then to where we are this morning. So European equity futures seen just slightly softer, just given that gradual decline that was really seen in the US in towards the close. Taking a look yesterday, obviously we had a really big down day in gold on what was apparently a fat finger trade. We heard there was reportedly a notional $2 billion worth going through the market on that flash kind of crash. Little blip, or large blip I should say, to the downside. That consequently did weigh on some of the gold miners overnight, which the ASX, which is the Australian equity market, heavily geared towards those resource type names. So the Australian stock market underperformed overnight on the back of that. And then we had the Chinese data, Shanghai Comp, Hang Seng, though relatively unmoved by stronger industrial profit growth, counterbalanced by the PBOC refraining from liquidity injections for the third straight day. Quite interestingly though, looking at gold this morning, obviously we've had a bit of a blip higher here. The first thing I typically do when I see a move like that is I'd put it on a 1 minute chart to see what was the move like. I know from just having sat here from around that time, I've not seen any headlines to create that kind of move. But looking at it, it was over a pretty quick succession. I would say at that time of day, it's fairly low on the liquidity. Probably a few orders going through the market and the price coming back. And I guess if you think about it logically, if that was a fat finger yesterday, i.e. a trade that was not supposed to be executed in that type of size, then naturally we should really reverse back to the point of where the price was. Likelihood the person was looking to place a sell order, just hit too many zeros on the keyboard. And then we've shot lower, so we're back to pretty much a full retracement this morning of that move before declining a little bit here, back to 12.50. So we're up around $4 in gold. Which could consequently be a little bit supportive if we continue that move. Certainly oil is also a little higher this morning, up 23 cents. If gold and oil obviously start to move in tandem to the upside, then I'll be keeping an eye on those commodity linked currencies. The Aussie and the CAD seen a little bit firmer since we UK and European participants have come into the marketplace. Oil though finding a little bit of a turnaround from that gain that was seen just this morning. We managed to briefly get above the high print from Monday morning session, however it's failed to sustain. Worth noting, I have seen a flash of information come down this morning saying Libya's oil production is up to 935,000 barrels per day, up from 885,000 barrels per day last week according to a Libyan oil source. Now if you remember, Nigeria and Libya at this point both remain exempt from that latest OPEC deal, and a lot of the issue about this big decline that we'd been seeing in oil ever since that OPEC meeting was not only about the issue of US output rising, but also about production coming back online to a large degree from Libya and Nigeria that pretty much negates then the whole purpose of the entire OPEC cut due to the size in which they're ramping up production. So quite interesting then to hear Libya, only within the last week they've managed to increase production by an additional 50,000 to 935,000 now. So despite the, I guess, the flaw that we seem to have seen with this really aggressive downward trend, I mean if I mark up the chart here, the OPEC meeting of course was on the 25th of May. That was exactly there, right at the peak. And again the decline, because we'd already priced in the outcome of a 9-month extension. If anything, it was a disappointment that they didn't do more. A deeper cut, a longer extension, or defined quotas for the likes of those two countries we just mentioned. US output continuing to increase, and we've just continued to move lower. But we found a bit of a floor at 42. That's when we started to hear a couple of noises from OPEC sources and so forth about potential talk. At that point they were talking, I think it was Iran, about potentially, or Iraq, deeper cuts being contemplated. Seems to have done the job for now, but still remaining relatively bearish on this trend in general. Any recovery, I would say, looks to be fairly limited given the fundamentals that are in play at this present point. Okay, quick look at some of the news headlines then from this morning. As I said, it's been relatively quiet, so a bit of a UK focus for you. Obviously yesterday we had a bit of a stabilisation, if not a bit of a rally in the pound, once we finally got the agreement signed off between Theresa May and the DUP party. And essentially Theresa May agreement to give Northern Ireland an extra £1 billion over the next couple of years in return for supporting her minority government. If you were to translate that, that would be the equivalent of spending almost £60 billion across the UK. You know, if you're looking at a proportionate size and performance of Northern Ireland comparative to the UK as a whole, the same equivalent percentage, if you like, would be if you were to give the UK a stimulus boost of about £60 billion. And just a really interesting graphic here from the FT this morning, in an article. They were doing various calculations to how important is a billion. You know, this is kind of the question that I ask when I hear these types of numbers. Is £1 billion in the financial markets is not a lot of money compared to, you know, when you think about Italian banks getting bailed out for £5 billion for a start. But £1 billion for Northern Ireland, how big is that? How important is that as a figure? The FT doing some calculations, and the 1 billion is also the equivalent of 2.9% of the Northern Irish economy in 2015. For the UK as a whole, extra spending of 2.9% implies about a £58 billion bill. So quite interesting how much would the DUP agreement cost if it were UK wide. You can see here it'd be absolutely huge if it was done on a UK equivalent of GDP basis. So it is a big deal for Northern Ireland, and you know, they've managed to come out of this with a bit of a game changer in terms of their economy, if not holding, if you like, the Conservatives knowing full well that they need them on board, and so they've managed to strike what is for them monetarily a very good deal for the amount of money that they've acquired. Quite interestingly, if you were looking at, just to put it in context of the UK, this bottom chart here is budget surplus and deficit for UK nations and regions. So if you look at England as a whole, we currently run a budget deficit of a small amount of a few billion. In terms of, this is percentage. So budget surplus deficit of UK nations and regions. If you look at London, London runs a surplus equivalent to 7% of its economy. And actually then that feeds through into distribution across other parts of the UK economically, in terms of financially. The southeast also budget surplus, as is the east of England. But if you look at Northern Ireland, it's almost 30%. So Northern Ireland has by far the worst public finances of any region in the UK. It runs a budget deficit of 29% of its economy. That's almost 3 times the amount of the UK's deficit at the height of the financial crisis as a whole. So Northern Ireland and Wales, you can see, are highly dependent on obtaining these types of funding, if at all possible, and this obviously is going to be much needed for Northern Ireland in this particular case, essentially as well, given the difficulties that they're likely to experience in the Brexit process. So maybe a bit of context there, quite interesting graphics from the FT. But looking at some other things that have come out, consumer confidence. This is a thing we've been tracking in the UK for quite some time, and that's because consumer confidence in the UK generally has been dissipating under, you're kind of used to the general summary of what's going on here. People's living standards are decreasing, real wages are negative, political instability, potential that then that could hit house prices, higher inflation, cost of goods going up, potential threat of an interest rate rise. All of these things then are making consumers in the UK less and less confident. And if you look at this on a chart, then consumer confidence dropped after the June election. just given the lack of confidence that people have now had in the ruling government, in particular Theresa May's performance and showing campaign and hung parliament. This has caused the biggest decrease that we've seen in UK consumer confidence into levels that have not been seen since immediately in the aftermath of the EU referendum itself this time last year. Looking at the breakdown of the UK economy, a couple of interesting headlines that I've seen this morning. Debenhams, not a big company. I believe they're now have recently been relegated from the FTSE 250, so they don't even qualify for the smaller benchmark index in the UK. But they are a good barometer of general consumer appetite to spend. And Debenhams have warned this morning of market volatility after a weak period of sales. One section of companies, though, that are benefiting are UK supermarkets. As you can imagine then, given the price of goods is going up, they're charging more. People are still buying groceries. These are products in which are necessities, things like bread and milk and sugar, things like that. And so UK grocery sales have hit, in fact, their highest rate since 2012. Lower brand discounters like Lidl, for example, outperforming the market against those such as Waitrose, Sainsbury's and so on. So kind of making a bit of a picture here as to the UK scene at present. Where cable is trading this morning, it's looking relatively uninteresting at this particular point in time. It's sitting around pivot, but if you're looking in the context, I guess, of yesterday's range, it's pretty much exactly midpoint. So probably not looking to really get involved there unless we start to see a bit more movement beyond these current levels. One thing that we do have later, 10:30 this morning, is the UK Financial Stability Report. I'm not going to talk about this in too much detail, mainly because the Financial Stability Report very rarely does it have an impact on financial markets or the pound or UK assets. It's more of an update in regards to the framework over UK banking system, consumer borrowing regulation, that type of news. This is in your inbox, so if you want to take a read, that's happening at 10:30. Just given the fact that Mark Carney will be delivering this and there will be a Q&A session, it's definitely worth monitoring given the mixed hawkish and dovish signals that we've had from the Bank of England over the last week. Quick look at the calendar then. I am mindful that we do have ECB's Draghi speaking coming up in the next 10 minutes, top of the hour. So want to get into that in more detail and listen to what he has to say. That could be important. So this morning, really it is very quiet. There's not a great deal going on. The Financial Stability Report, as mentioned, from the UK will be at 10:30. Then going through into the afternoon, again, very quiet. You've got consumer confidence from the Conference Board in the US at 3 o'clock and Richmond Fed manufacturing. That's really your main data from the US, and that's at 3. S&P Case-Shiller is largely a non-event in terms of market moving potential. The main thing to look at the calendar here, and a thing that I suggested to keep an eye on for anyone contemplating trade setups or strategies for today's session, you must be aware of all of the central bank speakers that are speaking. ECB Forum is underway. That's where ECB's Draghi will be speaking. I guess he'll be giving opening remarks here, so unlikely to be too explicit, I'd say, about policy of the economy. It's usually in the opening of the forum itself, but it is the president speaking, and so hence you need to be tuned in and monitoring the event. You've then got Fed's William just past 9 o'clock, Coer 9:30, the RBA Assistant Governor, so for Aussie traders that's at 9:30, Williams 10:30, Bank of England Governor. After the Financial Stability Report comes out, he'll then hold a press conference. You are absolutely littered with central bank speakers. You've got the head of the ECB, you've got the governor, assistant governor of the RBA, you've got senior Fed officials, including Fed Chair Janet Yellen this evening, and you've got the Bank of England governor. So don't be caught out by comments coming out from some of these influential central bankers. Have this calendar or these times on your desk, and be aware of that if you are in a trade, and it could be influenced by these speaking events. With that in mind, I'm not going to speak much longer because we are coming up to 9 o'clock. I want to let you guys get on and listen to Draghi as he starts speaking. I believe John P, thank you, you've put a link to that in the chat room. I'll share that with the other chat rooms as well. Okay guys, that's it. That's your briefing. Enjoy your session. I'll be in the chat room, so any questions let me know. Have a good day.